Welcome to the Deep Dive. We're diving into a topic that's, well, kind of hard to ignore these days. Cryptocurrency. It's everywhere you look, but it can be a bit of a head-scratcher.
Yeah, it really can.
Luckily, you, our amazing listeners, have sent in a whole stack of articles, research papers, even personal notes about crypto. It's a real mix, and that's great.
It is.
So in this deep dive, we're going to sift through it all, pull out the good stuff, and try to give you a solid understanding of this whole crypto world. A shortcut to feeling a little less lost, you know?
Absolutely. We've got deep dives into the tech itself. We've got people looking at it as an investment. And we've even got some warnings about, well, yeah, about the potential downsides.
Yeah.
Our goal is to weave it all together. So you not only know what crypto is, but also how it ticks, the potential upsides and the risks, and really the key things to think about if you're even thinking about dipping your toes in.
So let's just start at the beginning. What exactly is cryptocurrency? At its core, I mean.
Okay, so in the simplest terms, it's basically digital money, virtual cash. But it uses cryptography, that's where the crypto comes in, to make transactions super secure and to control how new coins are created, which is really important. What makes it really different is that it usually operates on these decentralized networks. So no single bank or government is calling the shots. And these networks usually rely on this tech called, you guessed it, blockchain.
Blockchain. Everyone talks about it. But can we break it down, paint a clear picture for our listeners?
All right, so imagine a digital notebook, like a shared one, that everyone in a group has a copy of.
Gotcha.
Every time someone makes a new entry, like say a transaction, everyone in the group gets a brand new identical page added to their notebook.
Okay, I'm picturing this.
Because everyone has the same record, it's really, really tough for someone to mess with it without everyone else noticing.
They'd get caught red-handed.
Pretty much. And that's basically blockchain. A distributed ledger, all fancy sounding, that's kept up by a network of computers. These are called nodes. Each one has a copy of every transaction ever made.
So instead of a bank tracking everyone's money, it's this network of computers.
Bingo. And that's a huge shift in how money can work, you know? To really get why this was a big deal, we got to think back to when Bitcoin first popped up.
Okay, back to the early days.
Yeah, 2008. This person, or maybe a group of people, going by the name Satoshi Nakamoto, they proposed this idea, a peer-to-peer electronic cash system.
Cutting out the middleman.
Exactly. No more need for banks or payment processors for online transactions.
Interesting. So what were the issues with the old system that Bitcoin was trying to fix?
Well, Satoshi pointed out a few things. First, traditional online payments, they're not always final. A bank can reverse a transaction if there's a dispute. And that's good for buyers sometimes, sure.
Right, it protects them.
But it also creates extra costs and risks for, the sellers. Second thing, for small transactions, like buying a coffee, the fees charged by those middlemen can be a real pain.
They can eat into the value.
Yeah, they can make those tiny payments just not worth it. And the last thing, traditional systems want you to share a ton of personal info just to buy something.
Which can feel invasive.
Exactly. Bitcoin aimed to be more like cash in the digital world. Direct, low fees, and less need to hand over your entire life story. This whole shift to a system without one big boss calling the shots, that's crucial to grasp.
Gotcha. Okay, so how does this decentralized system actually work its magic? We've got the blockchain, the nodes. How do they all agree on what's legit?
That's where these things called consensus algorithms come in. Think of them like a rule book that everyone on the network follows. They use it to decide which transactions are kosher, which ones should get added to that shared ledger.
Keeps everyone on the same page.
Literally. It makes sure all the nodes agree on what the blockchain looks like at any given moment.
So let's say someone wants to send some Bitcoin. What happens, step by step?
All right, so you want to send Bitcoin to, I don't know, your favorite podcast host.
Always appreciated.
Your request goes out to the entire network of nodes. It's broadcasted. Then these nodes, they get to work, checking everything.
Double checking, triple checking.
Right. They see if you actually have enough Bitcoin to send, if your digital signature is legit, all that. Once enough nodes agree that everything's on the up and up, it gets bundled with other good transactions into a block.
Packaged up and ready to go.
Exactly. On the Bitcoin network, this happens every 10 minutes or so. And usually it includes something like 2,000 transactions per block. This new block gets added to the blockchain, and boom, it's all recorded permanently.
And it's all out there for everyone to see, right? Transparency is key.
Total transparency.
Yeah.
Now, once someone buys some cryptocurrency, where do they actually keep it safe? I keep hearing about digital wallets.
Yeah, what's the deal with those?
So a digital wallet, it's not like the wallet in your pocket. It's software, or sometimes a hardware device that holds your private keys. These keys are what let you access your crypto and actually send it places. There are a bunch of different types. You've got mobile wallets, basically apps on your phone, desktop wallets, software on your computer.
So many options.
You've got web wallets that you use in a browser, and even hardware wallets, which are little gadgets specifically made to store your crypto offline.
Offline. Now, that's interesting. And I know there's a difference between hot and cold wallets, right?
There is, and it's an important one. Hot wallets are the ones connected to the internet, like those mobile, desktop, and some web wallets. They're easy to use for day-to-day transactions, but because they're online, they're a bit riskier. Someone could try to hack in. Cold wallets, though, those are offline. Hardware wallets and even paper wallets, you literally print out your keys. Those are cold storage. Way more secure, especially if you're holding on to a lot of crypto for a while.
Makes sense. Security is crucial. Now, let's go back to those consensus algorithms. You mentioned mining and staking. Can you explain those a little more and how they keep things secure?
You bet. Proof of work, that's BOW, and proof of stake, or POS. They're the two big ways that these crypto networks make sure everyone's on the same page and that nobody's cheating. Bitcoin is the classic example of proof of work. Basically, in POW, you've got these specialized computers doing a ton of work. They're run by people or companies called miners, and they compete to solve these super complex math problems.
Like a digital Sudoku on steroids?
Kind of, yeah. They're called hash puzzles. Imagine a digital race where the first one to find the answer gets to add the next block of transactions to the blockchain. And as a reward for all that work, they get some newly created cryptocurrency. For example, around block hashtag 660,000 on the Bitcoin network, the reward was 6.25 Bitcoin. So that's where the term mining comes from, sort of like digging for gold, but with computers. But here's the catch. This whole process takes a ton of computing power.
Energy intensive.
Yeah, which has been a big point of controversy for sure.
And proof of stake tries to do things a little differently.
Exactly. Proof of stake is designed to be way more energy efficient. Instead of all that crazy computing, it uses a process called, well, staking.
Staking your claim, so to speak.
Yeah, something like that. Basically, if you own some cryptocurrency, you can choose to stake it. It's like locking it up to support the network. Then the network picks someone who staked their coins to propose and validate new blocks.
How do they pick?
It can be random, or it can be based on how much crypto someone has staked. And the people who get chosen, they get rewards, kind of like earning interest on your savings account. Cardano, or ADA, that's a well-known example of a blockchain that uses proof of stake. With Cardano, users can actually delegate their ADA to what are called stake pool operators.
That's complicated.
It's a bit more hands-off, like a traditional savings account. The returns change over time, but for ADA stakers, it's been something like 3.3% annually, and operators get a bit more. But the key here is it uses way less energy than proof of work.
Interesting. Okay, so we're starting to get a handle on the tech side of things, but now let's talk about something that seems truly innovative: smart contracts and these decentralized applications. What are those, and why are they such a big deal?
Smart contracts are pretty mind-blowing, honestly. Imagine a contract, like a legal agreement, but the whole thing is written in computer code and stored on a blockchain, like Ethereum.
Okay, I'm listening.
Once it's set up, it just does its thing automatically. The contract executes itself when certain conditions are met. No need for lawyers or middlemen.
Sounds super efficient. What makes them better than old-school contracts?
Well, for starters, they're transparent. The code is usually public right there on the blockchain for anyone to see. So you can be sure it's doing what it's supposed to.
No funny business.
Nope. And they're efficient, obviously. No need to wait for lawyers to review everything. No need for escrow services. And maybe the best part, they can't be changed. Once a smart contract is on the blockchain, it's basically set in stone. Super secure and reliable.
I can see the appeal.
There's a catch, though. While the code's public, the people involved might not be. So it offers a different type of privacy. And if there's a bug in the code, a mistake, well, it's there forever. Can be costly.
Gotcha. So where do decentralized applications, or dApps, come in?
Decentralized applications are basically programs built on top of these smart contract platforms, like Ethereum. They run on a whole network of computers, not just one company's server. And this opens up a ton of possibilities for new types of services.
Give us some examples.
Things like decentralized finance DeFi, where you can lend, borrow, and trade without going through a bank. Or decentralized social media platforms, gaming, all sorts of stuff.
Wow, it's like building a whole new, more decentralized internet on top of blockchain.
In a way, yeah. Ethereum was really the first to offer this kind of robust infrastructure for smart contracts and dApps. It's like a central hub for this whole ecosystem of new decentralized services.
Exciting stuff. But let's be real, a lot of people are interested in cryptocurrency because they see it as an investment. What are the risks, and what should people do before jumping in?
It's super important to know that investing in cryptocurrency is risky. You can lose money. The market is known for huge price swings, and unlike regular money, most cryptocurrencies aren't backed by governments.
No safety net.
Exactly. So the golden rule is don't invest more than you can afford to lose.
Sound advice. Now, everyone talks about doing your own research, or DYOR. What does that actually look like in the crypto world?
Doing your own research is crucial in the crypto space. There's so much hype and speculation. You got to go beyond the headlines and understand what a project is really about before investing.
So where do you even begin?
First, figure out what the project is actually trying to do. What problem are they solving? Is it something useful or just hype? Also, look at the potential market. Is there a demand for this? And how does it stack up against the competition? Finally, look at who's using it, who they're partnering with. Are real companies or institutions getting involved? Those are good signs.
Makes sense. What else should investors be looking into?
The team behind the project is crucial. Who are they? What's their experience? Have they done successful projects before? Transparency is key. Do they give regular updates, have a clear roadmap for the future, and talk to their community? Looking at the roadmap can give you a sense of the potential risks and challenges they face.
So you're saying don't just buy into the hype, look under the hood.
Exactly. And one more thing, look at their partnerships. Can they work with others? Do they have alliances with established players? That adds legitimacy and can help them grow.
Got it. This sounds like a lot of work for the average person. Are there easier ways to get into crypto, maybe through more traditional investments?
There are. If all this sounds too daunting, there are managed investment products that give you exposure to crypto. Things like mutual funds and ETFs that invest in crypto-related companies or even hold cryptocurrencies directly. There are also private funds and services from firms like Fidelity Digital Assets. These can be a more familiar way to get started, but they come with fees, and you still need to understand the risks involved.
Good to know. Now, we've got to talk about scams. They seem to be everywhere in the crypto world. What are some warning signs?
Sadly, the crypto space attracts scammers, and they're always finding new tricks. The FTC, the Federal Trade Commission, has some good tips. For one, no legitimate business or government agency will ever demand payment in cryptocurrency up front. So if someone is pressuring you to send crypto right away, it's a scam. Run.
What about those promises of guaranteed returns? They're everywhere.
Yeah, those are huge red flags. Nobody can guarantee profits in crypto. It's just too volatile. Also, be careful if someone you met online suddenly starts giving you investment advice or asking for crypto. That's a classic scam.
What other tricks do they use?
They often pretend to be from well-known companies or government agencies. Or they might offer you a job that requires you to buy crypto. Another classic. Also, be wary of promises of free money or any claims that just sound too good to be true. They usually are.
So what should you do if something seems fishy?
Do your homework. The FTC says to search online for the company or person's name, plus the cryptocurrency name, and add words like review, scam, or complaint. See what others are saying. Remember, in just the first part of 2024, people lost a whopping $12.5 billion to scams. Be careful out there.
Wow, that's scary. Let's move on to the regulatory landscape. It seems like the rules around crypto are still being written. What's the situation in the U.S.?
You're right. It's all still evolving, which can be confusing. The big debate is how to classify and regulate different crypto assets. The SEC, the Securities and Exchange Commission, and the CFTC, the Commodity Futures Trading Commission, are both involved. Generally, the SEC sees a lot of cryptocurrencies as securities, especially if they were offered as investments. The CFTC often considers Bitcoin and some others as commodities, especially for things like futures contracts.
Are there any new laws coming that might clear things up?
There are some bills being discussed, like the Financial Innovation and Technology for the 21st Century Act, the FIT Act, and the Responsible Financial Innovation Act, or RFIA. These are trying to define different types of digital assets and create clearer rules. The FIT Act, for example, tries to define what a decentralized network actually is and separate digital commodities from more restricted digital assets. The RFIA is trying to clarify which agency, the SEC or the CFTC, should regulate which types of crypto. But remember, these are just proposals. They're not law yet.
Got it. What about taxes? How does the IRS view cryptocurrency?
Right now, the IRS says cryptocurrencies are property, not currency. So when you sell, trade, or get rid of it, It's like selling stocks. You might owe capital gains tax. For example, if you bought Cardano, ADA, and then sold it for a profit, you'd probably owe taxes on that profit. And if you get paid in crypto for goods or services, that's taxable income too. The tricky part is staking rewards. Nobody's quite sure if those are taxed when you get them or when you later sell them.
It sounds like the tax side of things is still pretty murky. Finally, with so much information out there, how can listeners find trustworthy sources for crypto news and research?
That's a tough one. The crypto space is full of people shilling, basically promoting projects they're invested in, often to pump up the price. And there are a lot of online echo chambers where people just reinforce each other's biases. You shared a Reddit discussion about this, actually.
Yeah, that thread was really interesting. It showed just how hard it is to find unbiased info. What were some of the more reliable resources they suggested?
They mentioned a few data aggregators. DeFi Llama and L2Beat are good for tracking decentralized finance and Layer 2 scaling solutions, respectively. DeveloperReport.com is useful for checking developer activity on different projects. And MoneyPrinter.info tracks token inflation. But they also caution against relying too much on AI-generated info. It can be wrong and needs to be double-checked.
What about more traditional news sources?
They said to be careful with social media, especially investment advice from influencers. They might have ulterior motives. They mentioned some professional organizations and news outlets like Blockworks and Bankless, but even those can have biases. Bankless, for example, focuses a lot on Ethereum.
So basically, diversify your sources and be skeptical.
Exactly. A healthy dose of skepticism is essential in the crypto world.
Well, this has been a truly fascinating deep dive into cryptocurrency. Let's recap the key points. We learned that cryptocurrency is digital money secured by cryptography, usually running on decentralized blockchains. Proof of work and proof of stake are two ways these networks ensure integrity. Smart contracts allow for all sorts of decentralized applications. Investing in crypto is risky, requires research, and watch out for scams. Regulation is still evolving, and the IRS sees crypto as property for tax purposes. And finally, finding good information means being critical and checking multiple sources.
Well summarized. We hope this deep dive has given you a solid foundation in the world of crypto, based on all the great material you sent us. We want you to feel more informed and empowered as you navigate this exciting but complex landscape.
And on that note, here's something to think about as we wrap up. Considering how quickly both the technology and the regulations around crypto are changing, what core principles do you think will ultimately determine whether cryptocurrencies succeed in the long run and how they'll fit into the global financial system? We'd love to hear your thoughts. And as always, we're open to exploring more questions and topics in future deep dives. Thanks for joining us.